What are the themes so far for 2026?
This is Ernie Goss here for Creighton's Mid-American Business Conditions Index, and our survey for the month of June was okay. In fact, it was very good, but the themes heading into 2026 and for the remainder of 2026 is GDP is remaining stronger than the labor market, and I think that's been the theme for the first and second quarter. That will continue into the third and fourth quarter, with GDP certainly outstripping the labor market. Job gains are still going to be, we'll see those being reasonably good, but much weaker than GDP growth. And what's happening there is investment. We're getting lots of data center impacts. We're seeing that pushing up investments. Likewise, imports have been reduced significantly, and that tends to push up at least the GDP number. So that's what we're seeing right now. Inflation is certainly outrunning the wage gains, and that's not good, of course. And we're heading into the elections in November, of course, and that doesn't look good for the incumbents. You certainly don't want to see inflation outstripping wage gains. What that means, of course, is that inflation rate is higher than the wage increases. And the Federal Reserve now, what they're tipping, at least right now, is no. I don't expect a rate cut or a rate increase at their next two meetings. Maybe perhaps the third meeting we might see something, and I'm on the other side. I think we might see a rate cut before the end of the year. I don't expect a rate increase before the end of the year. And the bias, as they state it, is biased toward raising rates. I don't think so. I think we're not going to see a rate increase simply because inflation is going to be coming down and the economy is slowing down. So a rate increase does not, in my view, certainly we see that.
According to supply managers in the 9 Mid-America states, how is the economy performing?
It was pretty good, a solid reading. The number was 56.0, and these readings range between 0 and 100, with 50 being growth neutral. 56, it's not like my chemistry grade in high school. The 56 is okay. That's a solid number, and that's up from May's 54.4, so we're headed in the right direction. We'll have to wait and see that national number, what it says when it comes out later on this morning. That's the fifth straight month of above growth neutral readings. That's obviously good. And it's consistent with solid, I'll call it solid, not fantastic, overall regional economic growth. What does solid mean? It means 2 to 3%. What would be very good growth would be a 3 to 4% and back to normal. So 3 to 4% is what we'd like to see. Even 4 to 5 would be even better. Now that's what we're talking about there is real GDP growth, meaning inflation adjusted GDP growth. On the trade numbers, like I said, the imports were down, and that tended to push up GDP for the second quarter, which now was rise upward. The last reading was 2.1% growth, annualized and season adjusted. Of course, that's good. The import reading, I should say, was 44.1, and that's down from 45.9. So we're seeing imports being constrained, and we'll continue to see that. Export reading, likewise below growth neutral, 47.3, and that's down from 47.4. Now here I'll bring up a graph charting the two surveys we conduct here at Creighton University. That would be the Rural Main Street Survey and the Mid-America Survey. That's in beautiful Creighton blue there. And you'll see there the 56.0, and that's up from last month. And you see the Rural Main Street number, actually it was up above growth neutral, and that was a surprise to me and perhaps everyone else, 52.6. And in there in red, you'll see what's called the PMI, Purchasing Management Index. It's the ISM reading. It'll come out later on this morning.
What were the hiring trends?
Hiring is still not good in manufacturing. The June number is 49.8. That's up from May's 47.0. And it's the 10th time in the past 12 months it's been below growth neutral. Just not, the manufacturing sector is just not adding employees. And what we ask, identify the greatest challenges to hiring and retaining employees. Why is it the employment is going down? Now, not much, but down. Not enough qualified workers was the number one reason. 36% said not enough qualified workers to replace outgoing workers. Compensation and benefits, 29%. Workers who show up late or absent, 21%, having to lay those workers off. And workers demand remote work, that's the remaining 14%. Over the last 12 months, U.S. manufacturing is down 47,000 jobs, and that's 0.4%. The regional manufacturing down by 15,000 jobs, and that's minus 1%. Now, since the pandemic, we're down 1.3% in the U.S. and 1.6% in the region. That's since the pandemic. Now, the other reading was over the past 12 months. What's happening in Nebraska and a few other states in the region is food processing. Food processing is shedding jobs and fairly significantly, and we'll have to wait and see. But again, here in Nebraska, we've had announcements of 2 more plants being closed. That's food processing plants. That's happening in Missouri, particularly Missouri, and other states in the region. So it was not good on the employment front, but again, it was pretty good in terms of overall manufacturing growth. So we're seeing a lot of solid growth, but not solid hiring.
What inflation trends are you noticing?
Inflation gauge is not where we'd like to see it. It's elevated now. It's 78.3. That's down from May's 81.7. So it's going in the right direction, just like oil prices are going in the right direction, just not fast enough. And that just indicates there's upward supply chain pressures, inflationary pressures. And this is disruptions from the Iran war and other supply chain disruptions. And to substantiate that, supply deliveries were at 62.5. And that's down a little bit from May's 63.9. What that means is supplies are delayed, deliveries, supply chain bottlenecks, and of course that pushes up prices as we talked about earlier. U.S. inflation remains well above the Federal Reserve's target, about 4%. That's their chief gauge year over year, 4%. The target is 2%. But that's the PCE, personal consumption expenditures. PCE just came out last week. And so that's year over year. We asked how much higher input costs from tariffs and Iran war and other bottlenecks, how much of that increase in cost are being handed off to your customers. 36% said all of it, all of it. In other words, costs are up 10%, your costs to your customers up 10%. And 50% of our survey said less than half, and 14% said no, we absorb the cost. So 14% saying we absorb the cost, 36% said nah, we pass all of it on to our customers. So that's what we're seeing.
What is the economic outlook?
The economic outlook, the Fed meets again on July the 28th and 29th. I say there's a 30% likelihood of an increase and 70% no change. So I'm on the side of no change. I think as we get closer to that date, we're going to see that the Fed's not anxious to make a rate change right now. They're trying to gauge the rock and the hard place. The rock, the inflation is too high. The hard place, job growth is too low. So they're caught between the two. Warsh, listen to what he says in the post meeting after on the 29th. He'll come forward and talk about what's going on in the economy. Listen carefully to what Mr. Warsh says. And keep an eye on the Federal Reserve's balance sheet. That's the one that Warsh used to talk about when he was not the head of the Federal Reserve, when he was on the Open Market Committee making the decisions. He was a governor. In other words, there are 7 governors, 5 Federal Reserve bank presidents. They come together to decide. Those 12 members decide what's going to happen in terms of short-term interest rates. And on the other side, Warsh has always talked about that too. He didn't like the quantitative easing. Well, it's still going on. They can just call it, we don't call it quantitative easing. What do you call it? Well, we're not going to call it anything. We're going to act like it doesn't exist. How about that? It's about $1 billion a day being injected into the economy. So where's the inflation coming from? Part of it's coming from that injection. So Warsh would like to bring that down, but again, he can't move much. Too many obstacles in his way. The CPI is too strong, and PPI, the producer price index, is much too strong, 6% year over year. That, in other words, these wholesale prices, which I talked about earlier, these are being pushed into the consumer price index. Now, on the flip side, we're seeing some pressures coming down. That would be fuel costs coming down and rents coming down. Those are big issues. Housing prices coming down. So that's going to keep the Fed, I think, to move inflation down instead of growing. Now, it's going to grow for the next couple of months, but look for it to come down in the fourth quarter of this year, in my judgment. Long-term interest rates are going to move higher, unfortunately. And that's not controlled by the Federal Reserve. That's controlled by you and me and all the investors on the face of the globe. Keep an eye on the bond market. That'll tell you the 10-year bond. That sets the pace for long-term treasuries. Those are long-term treasuries, I should say, which set the interest rates on things like such as mortgage rates and so on. Watch the ISM number, which comes out later on this morning. I think it's going to be above, heading higher like ours was as well. Listen carefully to statements by the 12 members of the FOMC, as they may do a lot less talking now that Warsh is in charge of the Open Market Committee, the Federal Reserve, head of the Federal Reserve. So there's probably going to be less talking. Keep an eye on the junk bond yield, the difference between the high yield corporates and the 10-year treasury. I expect that to move up, meaning that the 10-year treasury is likely to move down, and the corporate bond yield, high yield, is going to move up. Now, when I say, and I know some of you are going to say, wait, now you just said you expect higher long-term interest rates. Well, it's going to take a couple of months for that. Right now, we're moving a little bit higher. But again, the 10-year treasury, I expect to move lower. So in the third and latter part of the third quarter, fourth quarter, we're very likely to see mortgage rates moving lower. Latter part of the third quarter, fourth quarter, see mortgage rates moving lower. And Friday's jobs report, this Friday, pretty important. The ADP number later on, coming out after we record this morning, ADP, this is Wednesday morning, the ADP will come out in their private job additions. And that number, I don't think it's going to be quite as strong as we'd like. It's probably going to be between 50 and 100,000, which is okay range, but it needs to be higher. And keep an eye on the value of the dollar. The dollar's been moving higher. That's not good for gold prices, not good for silver prices. So silver prices could move down to 50. It's now about 56 as we record this. The gold prices moving below $4,000, headed maybe to as low as $3,500. So that's a lot to do with the value of the dollar. The value of the dollar is moving up, and just the fight for liquidity. In other words, everybody's fighting for liquidity, meaning you want to buy this SpaceX, you got to get some cash in there. So what do? You sell some gold to buy SpaceX. And of course, other products out there like Intel and other semiconductor manufacturers. A lot of investors are selling gold, selling silver to buy these other products. And as you know, there'll be some other coming forward. There'll be some other stock sales that'll be coming up, taking liquidity out of the market. All in all, it was a pretty good month for the manufacturing sector, except not enough jobs were added. Until we meet again, may your economic cup runneth over, and thank you.